to party. Who it up, she baby. I won't tell nobody. 내가 널 지켜줄게 however you want it, my baby.
Hello and welcome back to another episode of Navigating Teens with Hazel. Okay, let's be for real. I only invest in Starbucks coffees and sneakers. However, today we're going to fix that with someone who actually knows what to do with money. Please join me in welcoming Mr. Rahul Arora, the CEO of Nirmal Bang, one of India's well-known financial firms. In 2010, when Mr. Arora was just 30 years old, he became the CEO of Nirmal Bang, proving that age is no barrier when talent meets opportunity. He also made his mark in the media world as a senior anchor and analyst at CNBC TV 18, where he became the face of key market programming such as Markets Midday and Mid-Cap Radar. His ability to simplify complex financial concepts and present them with clarity made him a trusted voice for viewers and investors alike. From the newsroom to the boardroom, from investment banking to entrepreneurship, his journey is a remarkable example of drive, versatility, and leadership from a very young age. Hello, Mr. Arora.
Thank you for having me, Hazel. And it just sounds like I'm a lot older than I actually am.
No, but I'm absolutely thrilled to have you here today.
Thank you so much. Means a lot to be here.
So let's dive right in. We always hear that starting early with investing is very important. So can a teen really invest?
Absolutely. And I think there is no better education today than understanding the value and the importance of money. I think what is taught in schools and colleges over a period of time has to evolve. And I think if you look at any facet of life and any relationship of life, it is the centrifugal force around which it revolves today. And I think with the advent of the internet over the last 20 years, with a lot of companies that are coming in and going digital, you pretty much have access to everything at the palm of your hand through your smartphones.
So at what age can a teen start and how will it make a difference?
So I think, okay, there are two separate issues. You can start as early as you probably think you have a reasonable understanding of it. I would say someone who's probably just finished their 10th, it's not a bad time to start. You would have had some basic level exposure to accounts, to economics in your 9th or 10th and 11th. So somewhere around that age group of say 15 to 17, you would be very conversant with what's happening on the global front. You would, get understanding to things like oil prices, currencies. I think you'd probably have a better understanding of it. Obviously, the money that you will be investing will probably be pocket money that you're taking from your parents, and there's nothing wrong with that. You've got to start somewhere. Treat your parents' pocket money as what we call seed capital and try and build on that. So I think that's the first aspect. So it's never too early, but I think if you're trying to, beat that age of 16, 17, you'll probably have a challenge. So that I think is the first part to your question. The second, I think, and more important, is how you evolve with respect to investing. And I think there is a certain amount of independence that comes in, and it forces you to think in a slightly more mature way above your age. And I think when you start understanding the value of money, right, sometimes people get it very easy. Sometimes, your grandparents or your parents have done well in life and you just get a lot of money with ease, and you sometimes don't understand the value of money. But I think part of understanding the value of money is also losing money. And I think it's a very, very important part. So when people invest in the markets, whatever mode they may use, passive or active, they think it's always about winning and profits and things like that. That's one of the side effects of the age of technology as well, because you get so many tips and so much access to information. Sometimes you can get lost in the jungle. But I think from a personality building standpoint, from an understanding of money, understanding losing money and appreciating its value as a result of it is a very, very important you evolve better as a person.
I think that was a really insightful answer and it will help a lot of viewers out there. My next question is, we know that a bank saving account gives us 6 to 7% return. So, what alternative option do teenagers have?
So certainly, I think if you're looking at the stock markets, if you're talking about just going beyond bank savings, you can either invest in government securities. That is one, which is a very safe investment. It's underwritten and backed by the government of India. The other is, of course, a standard fixed deposit, which is the other alternative. But again, the interest rates will be very similar to what you were suggesting. Of course, senior citizens do get about 50 to 75 basis points higher. So if we're getting, say, 6% on fixed deposit, senior citizens may get 6.5, 6.75. Of course, that depends on where interest rates are in that cycle. And then, of course, you can invest into the stock markets. Now, investing in the stock markets also can be done in multiple ways. You can either directly buy or sell a stock. You can mandate a financial advisor and ask him or her to do it for you. You can either do it through a systematic investment plan and actually invest in mutual funds where you can link your bank account to it, to which a large part of my investments still today, when my salary comes in, gets automatically deducted in the mutual funds that I invested. And there are multiple schemes. There is a huge as in life, when you talk about inertia, you're either active or passive, right? So investing is also active or passive. Active basically means you're monitoring your portfolio practically on a daily basis or very actively. You're buying and selling more frequently. Passive is you buy it, you keep it, you lock the sort of trunk, so to speak, and let the market take care of it. I think if you're starting out as a teenager, I think probably the best way to do it would be through a systematic investment plan in a mutual fund.
All right, that was really informative. So, are mutual funds safe to invest?
There is nothing in life that comes with 100% guarantee, barring a mother's love. That's all I can say. I think everything else carries risk associated with it. I do understand that, the entire campaign that's run in India with the tagline Mutual Funds Sahi Hai. I think it's a great campaign to invite and involve more of the diaspora in India to invest in the stock market. See, Hazel, traditionally, if you go and see, say our parents or our grandparents, maybe they were not taught or somebody sat them down, but inherently India has been a market where investments have been more about real estate and gold, right? These are productive assets. They are certainly appreciating assets at different points in time. But real estate, for example, is not a very liquid asset class, right? So let's say somebody has a house, whatever value, whether it's 1 crore, 5 crore, 10 crore, it's not that I can decide to sell my house today and I can sell it tomorrow, right? Gold also has a process. It's a physical asset. With stocks, it's very different. You can, like we discussed earlier, you can buy and sell it off the palm of your hand. So, of course, the liquidity aspect of it comes into play in a very material way. But overall, I think it's very, very important when you're looking at stock markets to realize everything comes with risk. One thing I can tell you is if you look at mutual funds over a 3, 5, 7, 10-year perspective, almost 90% of the time you will make money. But there will be periods in that where you will see, oh, my portfolio is in the negative. You don't have to lose sleep over it. The art of investing is the art of compounding. And like we learn simple interest and compound interest in school, you just buy things and keep them and let them accumulate over a period of time.
That was a lovely answer. So, many teens think you need a big amount when you invest. So, is that true?
Not at all.
No.
Not at all. I think, you have stocks. See, when you look at the price of a stock, it's an actual rupee value, right? So you could be buying a stock, say that's 100 rupees worth, right? And let's say you have 1,000 rupees, you could technically buy 10 shares of that, right? So it's the amount is inconsequential. Of course, if you want to make a profession in this, there are two ways of looking at it. Are you looking at it as investing your surplus money, or is this something you want to make a profession out of? The way of approaching it is completely different in both aspects. I would still say in both cases, you start small. There is never an amount that's small enough. Of course, if you're doing a systematic investment plan, you probably want to have a meaningful amount of investment. Say, even if you do something like, say, 5,000 rupees a month, that's a good start. Of course, on a weighted average today, 5,000 doesn't have the same impact that it did, say, when we were growing up or when our parents were investing, because it seems like a very paltry sum of money today. But I don't think there is any amount that you have to start. Of course, you have to have a certain amount of money to be able to buy those stocks. But people have started. I mean, I know teenagers or people who started who had their first investment as little as 2,000-3,000 rupees. So there's no mantra or magic number at which you can start. Like I said, even 1,000 rupees can buy you 10 shares of a stock that's 100 rupees.
I think that's going to change the perspective of a lot of teens watching this. So, what's the biggest money mistake you think most teens are making now?
Investing in unproductive assets, going in for iPhones, buying digital stuff, depreciating assets. As my mom used to say, always invest in appreciating assets. I think, it's very important for people to realize what is a depreciating asset and what is an appreciating aspect. What are your needs and what are your wants? Very different. Like now, whether you buy a Maruti car or you buy a Mercedes, the moment you drive it out of the showroom, like literally the second you drive it out, if you want to resell it then and there, you'll probably resell it 20-25% cheaper. It's already considered secondhand. On the other hand, there are asset classes like, say, of course, we're discussing stocks. There is also art. People now invest in watches. These are appreciating assets, but they may not appreciate as much as, say, stocks would. But I think if you're investing in assets that are not depreciating in nature, certainly buy what you need, have a few wants, no harm in that. After all, what are we working for?
All right. Building on to that, there's so many exciting sectors right now, like AI, green energy, and EVs. So which sector do you think teens should keep an eye on?
Okay, this is actually a very easy question to answer and so also a very tough question to answer. Now, the reason it's easy is because I would always say invest in what you understand. If you don't understand it, don't invest in it. That's the first thing. The second is the three sectors that you speak about, which is EVs, AI, green energy, are all things of the future. Now, the future may be upon us quicker than we actually know. But if you look at the cost of electric vehicles today in India, and I'm not talking about Tesla here, just generally, even the Indian manufacturers who are making EVs, the cost of an EV car is actually higher than a petrol car. So one is the affordability factor. Of course, there are subsidies that the government of India gives. AI, again, if you want to invest in AI, you either invest in a company by buying a stake in a company, which basically means that whoever is the founder of that company sells you some percentage of his equity, or then you invest in companies that are listed and you can buy and sell the stock of that, which unfortunately in India today, there is nothing much to talk about on that front. Even on green energy, barring one very large industrial house that has invested a lot of capital, or maybe two of the larger industrial houses in India, there's not too much that's happening on a very big scale as of today. So when you look at EVs and AI, I mean, I think between the two, AI will probably be upon us a lot quicker. And then I think green energy and EVs will take a lot more time. I don't think that those are sectors that are to get too excited about today. AI for sure, but to where I started my answer, if you're looking to invest in things that you understand. And my advice to people who are investing for the first time would be invest in things that you consume. Right? Now, those could be soap companies, they could be shampoo companies, they could be car companies, they could even be alcohol companies for somebody who's, a late teenager, 18, 19 years old. You have, United Spirits, United Breweries kind of companies that make, beer and hard liquor. And then, of course, you have hotels. We all stay in hotels. There are a lot of listed companies in the hotel sector. So there's just so much to invest in, paints, and I mean, the entire plethora there. So I would personally say, let's say you go to a mall or you go into a grocery shop or you go into a multi-format store. You can see this shelf, you can see what's selling, you can talk to the guy on the shop floor. I mean, let's say McDonald's or Domino's. You just walk into a McDonald's store, you can just have a chat with the store manager, how much are you selling, how's business, so on and so forth. So for a lot of the sectors that you mentioned, you can't do that because it's still a very long shot away. And even if you look at the sales of EVs in India today, it's not great as a percentage of, I think, what the vision was 10 years back to where we are today. I think even the charging infrastructure needs to come in a very material way. So, great long-term stories. I'm most fascinated about AI from all of this. Of course, there's a side effect. You don't know what's real and what's fake anymore.
Many teens today dream of launching their own startup someday. So, once someone finishes their education, what are the 3 steps that they should take to move from idea to execution?
Wow. That's a tough one because so while I am still a salaried employee today, you could in many ways consider the company that I work for a startup when we started. So let me put it into context from that perspective. Because what I do is institutional equities, which is basically we recommend stocks to institutional investors, which are basically mutual funds, insurance companies, PMSs, alternate investment funds, and so on and so forth. So we were one of the last entrants, and our parent company did not have a significant presence in this vertical. So when I joined, it was literally about, putting the entire process together, from phones to, Bloomberg terminals to literally chairs and the entire gamut. So entrepreneurship, I mean, although the company was, of course, established and had been there for a very, very long time, but this entity being a standalone, separate entity taught me a lot, to be very honest. In fact, even the venture that I had before this with Ronnie Screwvala, which was him launching a business news channel as UTBI, which was later branded as Bloomberg UTB. Again, we were the last kids on the block there. So it was in many ways a startup. So I've done, in some ways, I've done 2 startups back to back, although by still taking a salary. I would not advise a youngster to straight away go into a startup. No, I certainly don't think that's the way to do it. I know sometimes the adrenaline rush is so high and the media hype is so much. And, all of us have traveled to the US and you hear of Silicon Valley and you hear of, people who are in the age group of 15 to 20 who are doing basic app development and selling it to, companies like Meta and Google for like $1 million or $2 million. And you're like, whoa. You have people who are in that age group of 15 to 20. And then, of course, companies like Google and Meta make it much, much bigger. But I think that's a very small section of society and a very specialized way of doing things. I think the journey of entrepreneurship should begin from a job. And I think the grind that it puts you through and goes back to the earlier point where we started understanding money. When you straight away start getting your check in your hand after taxes getting cut, you start realizing how much it hurts to pay taxes, even though it's the right thing to do. But I think that entire process of understanding people, so it's not just about showing up at work and doing the task or the job or responsibility associated with it, right? I think it's also working in a team, right? Coffee breaks, random conversations, ideating with people who come from different walks of life. What happens, Hazel, in entrepreneurship sometimes is you tend to impose your thought process and idea on others, which is not necessarily a wrong thing. Because if an entrepreneur has a brainchild or a vision, he or she would want people to conform to that, to take that vision to fruition. But I think it's a process of going through the grind, and maybe something that a lot of Indians from a very young age would understand, even from before their teens, is you don't straight away start playing for the Indian cricket team. You play Ranji Trophy, you play all the domestic tournaments, and then you build your way up, and that teaches you a certain method and a process. So I think first get into a job, work 5 years, do the rigor, and then by all means start your company and become a millionaire and more.
So, since we are speaking about startups, most successful startups like Zomato and Swiggy, they started off in losses. So, how can one identify if their startup is like a future unicorn or a sinking ship?
They're still in losses. They're still very much in losses. I think if I remember Swiggy, for example, since you brought it up, I think the only quarterly results that they have come out with, they reported an 800 crore loss. But I think there is an entire different generation of companies that has come into the stock markets in India, I'd say post the lockdown. I think post 2020, if you look at the last 5 years, I think some of these companies and investors have a very Americanized way of looking at them. And these may be, may not be the words that your audience is able to relate to straight away, but traditionally, when you invest in companies, you look at a few metrics. One is how is a company growing, right? One is what is your return on investment of a company? What is your return on equity? What is your return on capital employed? These are very important metrics, which, of course, a lot of your audience will learn as they go to school and college. But these are metrics that you benchmark a company on. I think what happened with the companies that you're talking about, and you can throw so many more in. You can throw in a Paytm. If you include beauty products, you could throw in a Nika. And then, Policy Bazaar on the insurance side. Most of these were loss making, and some still are. I think the way people started looking at them was customer acquisition, retention, and is there a substitute for these businesses? Gross merchandise value. How much are these guys actually billing? So I don't think people were looking at profit and loss and what we call return ratios from what I said. It just moved to a point where are these monopolies? Can these businesses be disrupted? How are they adding clients? How are they retaining their clients? And is this becoming a way of life? And I'm paying a valuation for that. You would find that a lot of these guys, when they listed, not only became unicorns or more, but then they eventually had to face a reality check and their stock prices crashed dramatically. In fact, most of the names that we have discussed right now became anywhere between a third to a fifth of what their all-time highs were. So they've actually gone through that grind. In India, eventually, if I was to say it in Hindi, it would just be, paisa banna chahiye. It's literally that's the way it is. I think it's amazing what people like Paytm or Swiggy, Zomato or Policy Bazaar or Nika have managed to do in terms of being aggregators, getting the valuation for themselves. But I don't necessarily know, looking at the mindset of the Indian investor even today, most mutual fund managers, Hazel, even today are in that age group of 45 to 60. And they've grown up in a very traditional and a very conventional way. So while they will take their profits while they can, I still think they will go back to the age-old way of looking at companies. So I don't know if these are structural wealth creators. They'll have their period in the sun. But I think for them to continuously make money, I mean, just go back to Swiggy. I think when it listed, the stock price went to 700, it came down to 300, and today as we speak, it's somewhere around 400. So it's still $200 lower than where it was. So I think the risk element in these is a little higher. The founders have made their money. The question is your audience who are going to invest in them, are they going to structurally make money? That is a very, very tough call to take for a lot of these companies vis-a-vis traditional profit-making companies.
Moving on to the fun segment now. This is called the rapid fire, and we're going to keep it short and sweet. So how this works is I will state a statement and you can give me a short answer for that. So one website you trust for mutual fund research.
Amphi.
All right. Startup or job after completing your master's?
First job, then startup.
All right. Defense, infrastructure or tourism sector? Your pick?
Defense and tourism.
All right. Your first investment ever?
A house.
One financial habit you wish schools taught?
The art of investing and how to compound your money, probably starting from the 8th grade.
Right. Credit card for teen, smart move or stay away?
No, stay away.
All right. More profitable in 5 years, freelancing or fixed job?
Fixed job.
All right. One myth about mutual funds that annoys you?
That they will always outperform the benchmark.
One financial term every teen must Google tonight?
Return on equity, return on capital employed.
One finance-related habit teens should build before they turn 18?
Start saving.
One finance book every teen should read?
The Intelligent Investor by Benjamin Graham.
What was your last purchase?
Zara.
Crypto for teens, yes, no, or maybe?
No.
On a scale of 1 to 10, how smart is Gen Z with money?
Their understanding of it, I would say 7. Their use of it, probably 5.
If you had rupees 1,000 today, where would you invest?
700 in stocks, maybe 200, 150 in gold. That would leave another 150. Maybe 100 in real estate and the balance in fixed deposits or savings, just to keep it totally diversified.
The Sensex has recently crossed 80,000. Where do you think it could hit 1 lakh? And what factors do you think would drive the growth?
I think it's just a matter of time. It could be we're talking about 20-25%, maybe a year or 18 months. I think we're getting into an era where inflation is under control. Interest rates are coming down. Some of the noises around the recent geopolitics seem to be easing. If they sustain, if the world doesn't become a totally crazy place with respect to wars, and oil stabilizes, I think all things said and done, I think we should be okay. We have a stable government in India. This is the third term of this government, so the policies are continuing. But I think if nothing goes out of whack globally, because I think, Hazel, at least, I'm 45 right now, and I don't think I've seen a more chaotic world in my 45 years where you're fighting wars on multiple fronts. So if nothing goes out of whack, given that we're in a low interest rate environment and oil stays where it is, probably 12 to 18 months is where we'll probably look at that 1 lakh index.
I think most viewers were looking forward for that answer.
Yeah.
So that brings us to the end of this episode. Mr. Arora, it was truly a pleasure having you here. Thank you so much for your wisdom and time, most importantly.
It was an absolute pleasure being on, and it was great fun. I'm so happy, excited, and proud to see what you're doing. And I wish you and this venture all the very best, and God bless, and more power to you.
So before we sign off, would you like to give a piece of advice to every teen watching this show?
Learn to save, learn to be bold, and don't be afraid to take risks.
Before I drop the mic, here is an afterthought. Your mobile doesn't ask you to think. It asks you to swipe. One tap and it's yours. And 1 week later, you forget you even ever bought anything. We live in a world of instant everything. Instant likes, instant food, and now instant regret. We must remember that being broke doesn't come from not earning enough. It comes from not thinking enough before spending. When you buy something, ask yourself, do I really need this? Or will this feeling last forever? Every swipe is a choice between what feels good and what actually matters later. As Warren Buffett once said, if you buy things that you don't need, soon you'll have to sell things that you do need. Also, remember that the primary rule is that we listen and we don't judge. Don't forget to like, share, and subscribe.